heart of where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Caroline Hyde at Bloomberg's World Headquarters in New York.
And I'm Ed Ludlow. This is Bloomberg Technology.
Coming up, we'll kick off our earnings coverage with a breakdown of Disney's results as the Mouse House beats expectations. But is it enough to fend off the activist investor?
Plus, the earnings coverage continues as we sit down for interviews with the CEOs of Lyft, Arm and Affirm, and Airbnb has some AI news.
And talking of AI news, we're going to be joined by Bethany Bongiorno, the CEO of Humane, as her company unveils its hotly anticipated AI pin. Will it replace the need for an iPhone? A product she helped build. That and so much more coming up throughout this hour. But let's get into what is a really hot winning streak. Can we eke out yet another day of gains on the Nasdaq? Will it make it 10 days? Will it make it the longest winning streak still since November 2021? S&P 500, though, up for 8, maybe call it 9 days. We're seeing the longest winning streak maybe since 2004. So clearly there is galvanization behind equities at the moment, largely because of what maybe the Federal Reserve is doing, dialing back the need to be hiking up rates. Certainly we'll hear from Jay Powell come 2 p.m. and also be getting some all-important bond sales. That's why we're seeing perhaps a little bit of pressure on the debt market at the moment. 30-year is where we're going to be seeing that sale 8 basis points to the higher side as we anticipate that supply coming through. We're looking at Golden Dragon, the index, the Nasdaq Golden Dragon. I wanted to shine a light on because China actually down just off by 0.7%. What's interesting now, it's not listed here because of course it faces sanctions, but SMIC, the key Chinese semiconductor producer, actually missing on estimates, even with it, of course, its integration with the Huawei product. That was some downdraft on the overall appetite for Chinese equities related to tech. Moving on, though, and I want to see what's happening in the world of crypto. We are pushing higher once again. I mean, we're off of those highs that we had earlier, at one point eclipsing 37,000, almost 38,000. However, we're above 36,000 once again. Dollar in the doldrums today, but we're currently up 2.3% on Bitcoin. What have you got, Ed?
This is a buckle up kind of show. We have a lot of news, some of it earnings, some of it actually standalone AI news, and we have a lot of CEOs joining us. 4 of them, their stocks reflected on the board behind me. Arm giving a forecast in the current period that has us worried about the smartphone market. How much is Arm a smartphone story or an AI story? We'll ask that question. Then you move on to Affirm, also with earnings. We'll speak to the CEO. Airbnb is out with some updated AI features that it thinks will improve reliability on the platform. We'll ask the CEO whether it will or not. And then to round things out, Lyft. Interesting, kind of traded choppy, really significantly lower when the market opened. We're now positive by 0.2%. Again, it's the forecast, the outlook for the current period going into the December quarter that worries us. Why are we now looking a bit more positive? The big earnings story, Disney. The story, continued cost cutting, $2 billion of additional savings, narrowing losses on the streaming business. The Bob Iger effect is working, but there's some activism still top of mind, Caro.
There is, and has this been enough to assuage, of course, Mr. Peltz when it comes to the focus on this company? Disney earnings, we want to dig in deep. Needham Senior Entertainment and Internet Analyst. I'm very pleased to welcome Laura Martin. Laura, ultimately, the cost-saving strategy, the fact that he's pulling back on spending on content and maybe even shedding yet more jobs, is it enough to assuage some of those concerns?
You know, I don't think so, because they just did $27 billion of content spending, and it should have been 30 because we had strikes most of their fiscal year at the Walt Disney Company. Now Iger's saying he's going to cut another $2 billion out of content. If you're a content company first, how do you cut spending lower than a strike year? So I think either he won't be successful, or the subsequent year he's going to have to spend a lot more to try to catch up. Otherwise, he's going to start. He had very nice subscriber growth for his direct-to-consumer business, 7 million subs, the most of any streaming company adds in the September quarter. If he cuts content costs again, he's suddenly going to have a horrible direct-to-consumer sub number. And so I actually don't think this will assuage Nelson Peltz, nor do I think this is a long-term strategy to cut your content costs.
You know, Laura, the streaming business is still such an interesting battleground. The company basically said that by the 4th quarter of the fiscal year we've entered, streaming can be profitable, which, given everything you've just outlined, it's hard to see. Do you see that?
You know, he's promised it for the last 2 years, since he got there 11 months ago or 12 months. So the answer is he sort of has to make it profitable. I think the question I have is, Will they do transfer pricing? Because when they put a movie on the big screen like Avatar and then they bring it to streaming, how much do they really charge the streaming entity for Avatar versus the linear TV business or the movie business? So I sort of think there's some transfer pricing there that he can make streaming look like it's profitable, even if technically, if it was a standalone company, it would not be. So he'll hit it from a P&L point of view, but that sort of begs the question about returns on invested capital. And he said on the call he really needs to get better content. They made too much content, and the Marvel stuff especially isn't really working any longer. So we need to get more hit films and hit series out of the Walt Disney Company now.
Timing is everything sometimes. The big headline, the actors' strike ends after 118 days. Why is that important now for a company like Disney?
So it's really important for companies like Disney, Warner Brothers, and Fox because they have this really robust linear TV payment stream coming from their broadcast television, their ABC, CBS, and NBC, like Comcast. And without that, Netflix has been exactly positioned for them. Like that's their competitive advantage over Netflix is they have these lovely TV series that are decades old. All of those have been shut down because the writers and then the actors went on strike. So all their sort of offerings looked exactly like Netflix offerings. So that's bad for them. Now they're going back to work. They're going to get more television content, new episodes, 40-minute episodes. That strategically is better for them compared to the Netflix competition because Netflix has none of that.
Meanwhile, they're going to be folding in Hulu, testing out how it is to have it all under one over-the-top product being offered come December. They're also, though, still eyeing what on earth they really do with ESPN to make it the digital force they want it to be. Where do you sit on the M&A storyline coming from the CEO right now?
Well, we would like to see Apple buy Disney, but that's an Apple question. So let
you
me
ain't
answer
alone, I think. You're not the only one that thinks that, Laura.
Okay, so, but I do think this notion of Disney Plus Hulu into a mega app is a good idea. We saw HBO Max merge with Discovery Plus, making a mega app. I do think that's where the world's going. Those mega apps are much more competitive with Netflix than standalone two different apps. And then on ESPN, what they said was they're talking to lots of partners because they want to create a new ESPN streaming app that sort of like corners the market on sports streaming. And so I'm very intrigued by who that might be, whether it's Amazon or Apple or Verizon, or they said it might be marketing support or distribution support or rights. I thought ESPN already had all the rights, but maybe not. So I'm very intrigued by ESPN. But to me, that's a little longer. He said at the earliest, that's going to be a 2024, 2025 launch. So I'm much more interested short term in the Disney Plus Hulu super app and whether that drives subscriber growth.
Laura, where's the innovation story with Disney? What makes Disney a technology company, if at all?
It is not. It is a content company, and right now content isn't working, so it needs to get that fixed. The content is the engine, and then what Disney does best in class is drive theme park attendance, consumer product attendance, linear TV bundles, streaming, subscription revenue. It drives everything off Avatar, Marvel, Star Wars. It is a content-first company, not a technology company.
Needham Senior Entertainment and Internet Analyst Laura Martin bringing the energy this Thursday morning. Thank you so much for your time. Now, coming up on the show, we are going to speak to Lyft CEO David Risher on the ride-sharing company's earnings. Kara, what you got?
I'm actually looking at the shares of Instacart. Now, remember, they reported after the bell. It's actually better than expected for this current quarter that they were really telling us the numbers on. But again, they are talking about macroeconomic headwinds. They're also talking about perhaps a dialing back of the advertising growth we'd seen as a real driver for them. But ultimately, they're talking about the several headwinds like the rest of the online industry are facing. And she says, we're still very confident, though, in their long-term opportunity of their business, particularly in online adoption in grocery in general. And they expect to expand their category leadership over time. So a very confident Fujitsumo, even though the market doesn't seem to be buying it right now. We're off by 9.5%. This is Bloomberg Technology. Let's just check check in on the shares of Lyft. A bit of volatility today, actually. Having been in the red, they're managing to push into the green as the ride-sharing company reported third quarter revenue that actually did beat analyst estimates. But look, it's the outlook once again that people are a little bit cautious around. It seemed to be a little tepid in terms of the sales outlook for the holiday period. We're pleased to welcome to the show now Lyft CEO David Risher. Great to have you here. And David, just spell out whether or not some of the growth that you saw, particularly Halloween being a bit of a blowout, if you can continue that and why not at the same sort of pace going into the final quarter?
You know, hey, Carolyn, it's good to see you. I actually think it's going to accelerate. And you never really know, but I can tell you for the couple of weeks leading up to Halloween this year, we actually saw record bookings in our company's history. And what that tells us is that people are getting out. People want to be connected with each other. So we actually just introduced a feature today that for a scheduled ride to the airport, if we're not there within 10 minutes, we'll actually pay you up to $100. We'll even pay you to take an Uber to the airport. We really want to reduce stress for the holidays so that people can get out and enjoy themselves.
$100 if you don't get your car on time. Even
That's
if you
right.
then take a taxi or an Uber, I mean, how much can you really pay on incentives to make sure that people become addicted to your product rather than the key competition?
Well, I mean, the truth is we don't want to pay a dime, right? Because we want to have a reliable product. And we do. We focus so much energy on making sure that if you try to get a scheduled ride to the airport, it's going to show up a couple minutes early. It's going to wait for you. It'll help you with your luggage if you need to. You know, that's what our drivers do so well. So, you know, our goal isn't to pay out incentives. Our goal is to get you to the airport. But if for whatever reason, traffic jam or whatever, things get backed up, you know, we'll get you there anyway, even if you have to take an Uber.
David, I think we kind of learned quite a lot about Lyft last night, the new data on gross bookings and on ridership. But that really got me thinking about your cost base and the take rate. And I know that's kind of old-fashioned finance speak, but you have had to incentivize heavily and supply hasn't grown. So I'm just interested in how long that dynamic can continue.
Yeah. So, you know, when we think about, you know, supply, that really means how many drivers we have on the platform. Our drivers are actually up 45% year on year. And the truth is, it's actually not been a very expensive proposition for us. The incentives that you're referring to were really important during COVID. Of course, people really didn't want to drive during COVID. But now we actually find so many drivers are coming back because it's a flexible job they can do on their own terms. They can drive when they want to, and then they can stop anytime they want to. So, you know, it hasn't actually been a big problem for us, and something that we think over time is going to be, you know, even easier to do is attract more drivers.
So for 2024 calendar year, what's your kind of reset goal for your company? You know, you're a relatively new CEO, you've galvanized the workforce. You know, I hear from a lot of sources that there is a good energy within the company, but you kind of have a lot of work still to do.
Customer obsession. Customer obsession. You know, customer obsession is what drives profitable growth. That's our whole thesis. And the better we can focus on our riders, the better we can focus on our drivers, you know, the more we'll grow. And we've seen this with, for example, Women Plus Connect, which we just launched in September, that allows women drivers and riders to request a ride with each other. People love that feature. Drivers love it because they can drive and feel comfortable, women drivers and riders for exactly the same reason. So these are the sorts of initiatives that are so customer focused, you know, focusing on, of course, 50% of the population, the women population, that can really continue to drive you know, satisfaction and therefore use of driving with Lyft and riding with Lyft.
David, I'm an obsessed customer when it comes to my bike. And I could send daily messages about docs not quite working. And I can imagine that it's a really hard infrastructure to try and create a perfect scenario for every rider at the moment, particularly in New York City, for example. Are you thinking of partnerships when it comes to the bikes? Are you thinking of divesting of that particular part of the business?
Yeah, so, I mean, I love the fact that you're a big cyclist. I know that you are. And by the way, you're not alone. In New York City, we typically provide about 160,000 rides a day, right? I mean, that's as big as a lot of public transit systems are. So it's a really significant thing for a lot of our riders. But as you say, it is, you know, sort of a complicated business. We're actually putting in new docks in New York. I don't know if you've seen them yet, but they're easier to dock. They actually charge up the electric bikes, which are a huge source of growth. But anyway, to your question of are we looking to partner? We are. We're looking to partner with organizations that can really continue to invest in the infrastructure that's needed so that e-bikes can be even more popular tomorrow than they are today.
David, I'm sorry, I want to go back to the supply issue because I'm reading the sell-side reaction. And even Women Plus Connect, you know, I see that as kind of a driver for ridership. But I wonder if that initiative has also brought more women drivers to your platform and made you more competitive on the supply side too.
It sure has. And it's such a good point because, look, only 23% of our drivers are women today. And by the way, they only drive 15% of hours. So what does that tell? Even though it's a great job, right? Because it's flexible, you can log in when you want to, you can log off, you can pick your kids up from school, you can go to your other job, whatever it is you want to do. So what that tells us is we need to continue to invest in bringing more women drivers onto our platform, which increases the overall driver supply, to your point. And that's what we see happening. We're now available in 50 markets across the United States. 55 across the United States. And it's super successful. So it's a great example of a customer-obsessed initiative that benefits both drivers and riders and ultimately makes it more appealing for everybody, which then, of course, drives growth, which drives profitability. That's how you build a great business.
David, we ask you once again, I think now for the third time, are you open still at this point to a sale or being acquired?
I love the consistency of the question. I'll give you a consistent answer. You know, we will always answer the phone. You know, that's part of the job, but it's not our focus. Our focus is on customers and just obsessing over them so that they can get, you know, home for the holidays. They can get to Thanksgiving stress-free. That's really the focus.
Lyft CEO David Risher, great to catch up. Thank you for joining us from San Francisco. We appreciate it. Now, coming up here on Bloomberg Technology, we speak to the Affirm CEO Max Levchin. A lot of emphasis on buy now, pay later. A big conversation coming up. This is Bloomberg Technology. Affirm shares absolutely surging today after the buy now, pay later company posted fiscal first quarter revenue and forecasts that topped estimates. Joining us now is Affirm CEO Max Levchin, and look who's here, our own Shonali Basak. Take it away.
Thanks, Ed, and thank you, Max, for joining us. Of course, the market is reacting to the numbers, the revenue, doing much better than expected. But there's a point that I want to touch on here first, and it's this idea of credit quality. Because even though you've seen a little bit of a deterioration quarter over quarter, it improved quite meaningfully from a year ago. Is that sustainable?
I will point out that even the deterioration, as you put it, was something that we had predicted and deliberately communicated to the market a quarter ago, where we said, look, we expect a slight increase through the summer, entirely seasonality related, and it will normalize right after. And that's exactly what we saw. So what all of this means is we are in control of the credit outcomes of the loans we make. And it is in contrast to the rest of the industry. You know, anywhere you look, you see delinquencies creeping up and folks struggling to maintain any sort of a quality credit performance. While we have been able to distinguish ourselves, it's not an accident and it's not a secret of any kind. It's the structural advantage that we have. We write very short-term transactions, 4.5 months is the weighted average life of a loan. And every transaction is individually underwritten, which means that we have an incredible degree of control over what we actually put into our book.
Max, the other thing that you've been talking about more at Affirm, you're a traditional buy now, pay later pioneer, but you now have the Affirm card. How much does that compete with the buy now, pay later model?
It's actually perfectly complementary to it. It's, to me, I'm heavily biased. It's sort of my baby, but it is for the moment at least, the peak of achievement of buy now, pay later. It's buy now, pay later on your debit card that works both online and offline, entirely with control into your hands. You decide if it's going to be a transaction that just settles against your cash balance or becomes a buy now, pay later loan. As always with Affirm, entirely transparent, no late fees, no compounding interest, no gimmicky, schlocky schemes to contend with. So it's the perfect embodiment of what we've been working on for a decade and more. So it's just complements to everything we've done, and we have incredible roadmap of plans for the card. We'll talk a lot about it next week at our Investor Forum event, but we have years and years to build into this thing.
Max, it's Ed here. Hi. We got Adobe Analytics data this morning that showed October was a record in the US for online spending, and BNPL was a big sort of contributing factor to that. I know you've talked about the Amazon relationship, and you just mentioned next week, but what other modalities do you see buy now, pay later kind of growing into going forward?
I think there's quite a lot more road to cover. I think the secular shift, especially among the young consumers, where about 2/3 millennial, and Gen Z on our consumer base, they ask for more transparency. They want easier way to understand what it is they're going to own when they're going to be out of debt. And so just that pull alone creates ample opportunity for a company like ours to grow. We think there'll be incredible growth in offline. We buy with buy now, pay later, and brick and mortar on our card, but also from our app directly. We think there are opportunities in small business lending. You've heard our announcement last week. We're going into sole props, and we think there are many small businesses would get help there. And so there's just lots of places where this idea of honest financial products makes a lot of sense, and the end consumer of this product is just hungry for it.
Morgan Stanley actually calling out how you're really communicating more clearly about the customer journey, how you can think about purchase capacity. Communicate with us about your investment capacity right now. How much do you want to be investing in the business when we do have perhaps calls that an economy is going to turn, when we are thinking about how much you need to outperform in terms of the world of AI? Where do you lean in on?
We're fundamentally a software development company. Everything we do in-house and write a lot of code. The results of this quarter speak for themselves, but they're fundamentally just a sign of how well we've been executing primarily in building great software and delivering it to our partners. That is our area of investment. We're not a marketing-driven company. We don't spend really barely any money to speak of in sales and marketing. We just build great products. And so when we speak of investment, we speak of hiring talented software engineers, talented underwriters, talented machine learning folks, talented AI researchers that are just make our products better. And over time, it pays for itself.
You raised your guidance, but even before that, your stock had more than doubled this year. On a 2-year basis, though, Max, you're still down. So I'm wondering if you look at the next leg for Affirm, the next big ambition, the way to drive growth moving forward, what is next? Is it going global? Is it cutting a big deal? How do people think about the story moving forward?
Yes, it is the short answer. We're already on the record that we have all the intention of going global. We spoke about United Kingdom as our likeliest next point of entry into the global market. We do think that there are plenty of retailers, both online and offline, that are still to benefit from honest financial products the way we build them. And so we are very active in the marketplace, and there are ample opportunities these days to help retailers move inventory, especially as we head into the holidays. There's a lot of interest in our products among merchants. And then just if you look at the sheer size of the market and our place in it, as lucky as we've been with this incredible growth, we are less than 3% last I looked of e-commerce. So there's just so much to go, and less than a flicker of scale in overall commerce. So we have a lot to go.
Max Levchin, Affirm CEO, we thank you, and our own Shonali Basak. From New York, this is Bloomberg Technology.
Welcome back to Bloomberg Technology. I'm Ed Ludlow.
And I'm Caroline Hyde, and I've got a quick market check for you because, look, we are on such a winning streak. When you look at the NASDAQ, we're actually up for, 10 straight days, longest since November 2021. If you look at the S&P, up for the longest winning streak potentially since 2004 if we cling on to gains. The bond market sells off as we anticipate some supply today, but notably I'm looking at Bitcoin on a tear once again. We're at 36,000. Moving on, the individual movers. Apple, an interesting one. Will they face a fine once again in the EU in the whopping 13 billion euro figure? That is potentially what's being advised. We're also looking at what's happening with the world of Airbnb because some product finesses, announcements coming after, of course, earnings previously. We're up just about 0.1%. 117 is currently where we trade, but we're going to get really the intricacies of ultimately what's going on with this business, how they're looking to improve and continue the consumer. And Ed, you've got so much more on that.
We welcome our Bloomberg Radio listeners and TV audience worldwide. Airbnb is unveiling new features and AI-powered tools for its app in a push to increase reliability. As part of the new features, listings rated above 4.9 stars with less than 1% cancellations from hosts will get a new guest favorite label. 2 million out of the more than 7 million homes on the Airbnb platform qualify for that label. Let's bring in Airbnb CEO Brian Chesky and our very own Emily Chang. Take it away, Em.
Thank you, Ed, and thank you, Brian, as always, for joining us. Look, we can count on you now to sort of up the ante with these new product features a couple of times a year. And as a guest, I'm excited about guest favorites. But at the end of the day, it's about driving new business. How many new additional bookings do you think these new features can unlock?
I mean, I think this is going to be a really big growth driver for us, Emily. And the reason why is the number one reason people like Airbnb is because the homes are unique. Every home is different. The biggest problem with Airbnb, and the number one reason people book hotels, is you know what you're going to get. And we asked, what if we can combine the best of both? What if you can have the uniqueness of Airbnb with the reliability you expect from a hotel? And that's what guest favorites are. But it's not our word. It's our guest word, because we took 370 million reviews and millions of customer service contacts, and we created this collection of 2 million homes. I think this is going to bring a whole new audience to Airbnb.
There was a lot of focus on your outlook last week when you reported results. You talked about macroeconomic trends. You said there's volatility. You said bookings could moderate and that you're already seeing signs from that in this quarter. Can you tell us a little more about this volatility? Where is it coming from? How dramatic is it? And how big is the impact going to be?
Well, mostly what we were doing is we were just a few weeks into the quarter, and we were seeing a lot of geopolitical uncertainty. So we just wanted to be cautious. At the same time, we feel like our business is extremely resilient. We've done $4.2 billion in free cash flow this year, trailing 12 months. That is a 44% free cash flow margin. Our revenue grew at 18% year over year. So we're feeling really good at this very moment. We just wanted to exercise a little bit of caution, just given what was happening in the world.
So you've said Airbnb is now ready to expand beyond its core. Can you give us a tease? Where is that next level of growth and monetization going to come from?
I think it's a few areas. I mean, let me first say, I think we've only scratched the surface of how big our core business of booking homes around the world could be. Next is international. You know, we're in 220 countries and regions around the world, one of the most global internet companies. And yet a lot of our business is still concentrated in the United States and a few other English-speaking countries. So whether it's Germany, Korea, Japan, Brazil, or many other countries, these are huge markets that we can grow. And that's going to create a huge amount of growth. And by the way, if there's ever a company that would be able to expand internationally, it would be a global travel network. And then beyond that, I think Airbnb can do much more than offer homes for people to book on a nightly basis. And I hope to be back on your show soon to be able to tell you about some of those things.
To our Bloomberg radio and TV audience worldwide, we are speaking to Airbnb CEO Brian Chesky. Em mentioned it at the beginning, these kind of regular annual updates. And I know you yourself are actually pretty hands-on product-wise. But it's all done internally. And I think about the investments that you've had to make to do the AI integration into this latest tool. Where are you spending? Is it just purely on talent?
Where am I spending my time or our money or both?
Time and money. Time is money.
I'm spending most of my time on the product. What I've spent most of my time in the last 2 years, and let me back up. Travel is one of the most aspirational things in the world, right? If you ask people, all the money in the world, would you do? They say they travel. And yet the way a lot of travel companies are run, they're run by just looking at the financials and look at the metrics. And we do that, but there's something deeper. You have to create an amazing experience for guests and hosts. And so what I've done is I've been listening over the last couple of years, and we made 350 major features and upgrades based on what the community's told us. We said that yesterday was a turning point, that when we could have a major answer for reliability, the number one reason people book hotels, now we have permission to do new things. Because people don't want new things from you unless they love the thing you do. I think people are going to love guest favorites, and I think we're going to be ready for us to see new things, and that's what I'm spending my time on. My time is spent on innovation and what's next for Airbnb.
And perhaps sometimes having to go and talk to regulators. And I think of some of the reasons people are buying hotels in New York is because there's less Airbnb supply. Yes. You called it basically a de facto ban here in New York. How is that going? What are you doing to try and push back?
Well, it means the way it's going is that hotels are now up 8% year over year from a cost perspective. If you have me on here next year, I'm going to make a prediction. Hotels will be more expensive. I'm not sure if housing will be down. So New York, I think, is turning into at least a cautionary tale. I'm disappointed of how it could go. But you know what? Other cities have chosen a different approach. We're 100,000 cities. In our top 200 markets, 80% of them have sensible regulation on the books. So we found a sensible solution. And whether it's London or Paris, in Paris, 500,000 people are going to stay in Airbnbs for the Olympics. So I want cities to know that we want to be part of the solution, not part of the problem. And we're willing to compromise and come to the table and find ways to make the cities work. And I think a lot of cities have found that path.
Brian, obviously what's going on in New York has been pretty dramatic. People are calling this the Airbnb apocalypse, and there are a lot of concerns that other cities could follow on, even if they do have smart regulation. Now, I'm sort of curious on top of that, what are the travel trends that you're seeing post-pandemic? Are people wanting to say, I'm tired, I just want a staycation? And, what changes are you seeing in travel trends for the folks who are going out?
So 2 things. Just on the first part of the question, we do not think New York is a trend. We think New York's late to the party, not early. I mean, again, we've worked with cities around the world. We now collect $9 billion of hotel tax, and I think that cities are not looking to New York. On the travel trends, it's really interesting, Emily. Before the pandemic, 80% of our business was people either crossing a border or going into a city. The pandemic, that was shut off. So what were people doing? They were getting in a car and they were staying in big homes, larger homes with their friends, their family, typically in less urban areas. So what's happening now? What's interesting is the old Airbnb is back, the old ways of traveling are back, but the new ways of traveling are here to stay. And there's 2 reasons why. Number one, even though some people are going back to the office more often, there's a lot of flexibility. You can now do more work from an extended weekend. I'll make a prediction. Next week for Thanksgiving, or the week after for Thanksgiving, a lot of people aren't taking 3 or 5 day weeks. They're taking 7-day weeks. They're going to work remotely Monday or Tuesday. So they're going to start taking those longer trips. So it's actually a very resilient business, and I think that more people are going to travel because it's what was taken away from the pandemic, and I think it's how they want to spend time with people.
I want that 7-day week, Brian. Last quick question. We've only got 30 seconds left. Affordability. You're bringing down cleaning fees. Prices have come down a bit, but do they need to come down more? And can you do that without alienating hosts?
Yeah,
quickly?
I think our secret sauce is finding this magic balance to make sure that on the one hand, the offering is affordable for guests. On the other hand, hosts are still making great money putting on Airbnb. We don't price anything. So what we're doing is we're just trying to provide transparency and tools and guidelines. Here's the good news. In the United States, prices are 3% down on Airbnb year over year, yet host earnings are at record highs, while hotels are up 10%. So the trend line's going in the right place, and I think hopefully a year from now, our prices won't be going up nearly as fast as hotels, and if that happens, it means Airbnb is a better value every year than the year before.
Something's deflationary. Airbnb CEO Brian Chesky, we thank you so much for your time. Bloomberg's Emily Chang as well. We love having you on. Thank you.
Thank you.
Now, coming up, we'll speak with Arm CEO Rene Haas is joining the show on the company's first set of earnings as a public company again. This is Bloomberg Technology. Welcome to our TV and radio audiences worldwide. Chip design firm Arm out with earnings for the first time since it returned as a public company. That was back in September. It beat expectations for revenue and adjusted earnings per share in the second quarter. Shares, as you'll see, under pressure at the moment. This is more about the outlook for the company. Best person to speak to about it, the Arm CEO, Rene Haas. It is great to have some time with you. And look, you're back trading it kind of where you priced on the IPO at the moment. I'm looking at a 51.20 at the moment. Tell us a little bit about the ongoing weakness in the industry when it comes to mobile, because you've been diversifying, but why is that not bearing fruit in the here and the now?
Yeah, thank you, Caroline. We had a record revenue quarter, which we are thrilled about. Arm has never done $800 million in a quarter. And we also raised our yearly guidance. So we're very, very confident about the outlook going forward. The stock's a little noisy, I think, based upon timings and things of that nature. But, generally speaking, what we're seeing is our royalty business has increased 3 quarters in a row. And what we're hearing from our partners that we're in the trough in terms of the overall inventory and getting better. And our licensing business is really strong. So as a result, great quarter, and we have raised our yearly guidance.
Okay, the context there is clear, and I'm interested about perhaps the AI focus that you've been having. There's been licenses for potentially a bit lumpy at the moment when it comes to companies wanting to deploy your technology within their AI offerings. I'm interested in when that becomes big volumes. When does that become more dependable rising royalties, do you think?
Yeah, so I think one of the things we saw this last quarter in terms of our increased licensing activity was companies looking to invest more to address this demand for AI and AI everywhere. I think the general perspective was that, You need more and more compute technology. What exists in systems today is not good enough. More is needed. So I think across all markets, we're going to see AI find its way into the end product. So for us, 70% of the world's population uses ARM. It's literally impossible to do an AI application without us. And we think over the next several years, it's going to drive great growth for us.
And for that, R&D is needed. And I go back to the fact that you sort of said there's noise around the share price. That's kind of the conundrum of being a public company, is the fact that you are a business that needs to spend internally, you need to innovate, you need to invest, but you've now got these short-term goals that in public investors want to see in terms of revenue build, in terms of profitability. How are you finding that tension as a publicly traded company with ultimately a more demanding public investor base?
Yeah, and as mentioned again, we had record revenue in the quarter. Our licensing business was up over 100%. So what that says is companies are increasingly spending money on developing products that have ARM inside. And based upon that and the royalty outlook improving for the year, we did raise our guidance annually. So as I mentioned, we're very, very confident about the year ahead. As far as the balance between R&D and meeting goals and things of that nature, yeah, it's something every public company CEO or even private company CEO has to consider. So I don't think we're in any different bucket there.
Welcome to our Bloomberg radio and television audience worldwide. Speaking to ARM CEO Rene Haas. Yes, the eagle-eyed out there would notice, Rene, there's a discrepancy, right, between the cautious outlook for the current period and then this kind of full fiscal year boost you had relative to the kind of guidance during the IPO roadshow. What accounts for that discrepancy? Why short-term worry, but kind of confidence that longer term you're going to start booking, particularly on the licensing side?
Yeah, so we've just returned to the public markets, and I think we've got some time to help teach the outer community about how our business works. Our licensing business is both a combination of timing and ratable revenue in terms of when we can actually recognize the revenue. We have great visibility into deals. We have great visibility in terms of revenue profile, which is why, again, we're very, very confident in the year. So inside the quarter, our licensing tends to be lumpy. Yes. Something might happen one month versus the next. But in the main, we're very, very confident and have great outlook in terms of when and if those deals will close.
Rene, ARM is still mostly a smartphone story, highly cyclical, low margin market. You made gains in data center and auto. Can you tell us when ARM will stop being mostly a smartphone story?
I think I can tell you that today in terms of mostly. We were probably 60% of our revenues prior to the acquisition, maybe more, were tied to smartphones. Today, it's less than half. So we are not mostly a smartphone company anymore. Our royalty revenues in the last quarter were up 20% in cloud and 20% up in automotive. So we have greatly, greatly diversified. And that's really a combination of both a very, very focused strategy to do so and the pull and demand for ARM technology driven by power efficiency. These megawatt data centers cannot afford to add more and more energy. And at the same time, your automobile running off a battery, it's a computer on wheels, needs to be very, very efficient as well. So the trends are in our favor, and we've also made the investment in the specific products. So as a result, we're seeing very, very strong growth across these other businesses. And I think you can say that today, we're not a smartphone company.
30 seconds left, Rene, which is always a joy for a CEO to hear. But I'm interested in London listing anytime soon?
London listing anytime soon. Nothing that I can talk about specifically today. It's something we're considering down the road, but nothing specific I can tell you today.
ARM CEO Rene Haas, thank you for joining us.
Thank you so much.
Okay, coming up on Bloomberg Technology, we'll be joined by the CEO of Humane, Bethany Bongiorno, for her take on the future of personal mobile computing and the launch of Humane's new AI PIN. This is Bloomberg Technology.
It's an AI-powered wearable device, but it's not got a screen. And it's what Humane is betting on with its new AI pin. It's a standalone screenless device, look, that you actually pin to your clothes like your lapel, and it has users engaging with it through its intuitive kind of touchpad to make calls, send messages, take photos, so much more, maybe translate what you're saying. You can use your hand. Let's bring in Humane CEO Bethany Bongiorno to the show, who's in San Francisco on the day of the launch. People will be able to start ordering from the 16th. I think people have already been on some sort of wait list for this. What made you build it ultimately? Because it's going to replace the phone, if I'm getting this right.
Yeah, thank you so much for having me. It's really great to be here today on a really big moment for us. We've been building for quite a while, and really the vision has always been to build the first personal computer that allows you to take AI with you everywhere. And that's really the vision that we've had since day one.
People have been so excited to see what you're going to provide, largely because you've got some big backers. You've got already $230 million raised. You came out of Apple, of course, key to their product development. Everyone waiting with bated breath. Ultimately, how do you think that this will be demanded for when it's the first of its kind, but there will be competition? We already understand that Sam Altman, one of your key investors, is looking at building a wearable with none other than Johnny Ive.
Yeah, I think it's incredible that we're at this moment where we are really seeing the fact that we're at the beginning of a new age of compute. I think it's incredible that there's a lot of excitement around the space, and we've been building this vision since 2018. We knew it would take some time to build an ambient, and very personal computer in the way that users expect. And I think it's amazing to see where we are now. And again, it's just the beginning.
Bethany, let's break down the hardware and software component. What is it that Humane's cracked on the hardware side, and what is it that OpenAI is bringing here on the software side?
Yeah, I think at the heart of it, we knew that we wanted to build something that was going to be as powerful as a smartphone. That's really challenging in a very small form factor. The miniaturization of it, the development of the antenna. We have an antenna that is truly global, that can roam anywhere. We also have a lot of technology packed in a very small package. And I think that's really the differentiator. This is a standalone device. It's not connected to any other companion device. This is something that is truly standalone and is network connected, and that absolutely has been the biggest challenge.
Caroline referenced the reports from September that OpenAI and Sam will work with Johnny Ive on an AI smartphone or device, and in common you do have the underpinnings of the AI technology. How will you work around that and remain sort of unique or competitive?
Yeah, I think that for us, what we're building is a true personal computer. We have both our own proprietary AI. We also use models from OpenAI and other models as well, and that will be continuing to grow over time. And I think we're just excited to see more excitement in the space in general. I think that means we're all heading towards a world where ambient compute will be part of our day-to-day life, which is pretty amazing.
So we're not suddenly dominated by our screen. Throw it to the side. Who and how did you build a supply chain into this at the moment, Bethany? Where are you managing to get this built?
Yeah, it was incredibly challenging, as you can imagine, building a company starting in 2019, building through the pandemic. We have some incredible partners across the globe, really, that have been part of this journey. Humane is a small company, but we have partnered with incredible groups of people around the world that allow us to really have the ability to manufacture in a way that I think hopefully will be able to live up to the demand, which we know will be incredible.
Bethany, are there plans for lower spec, kind of more affordable models of this for markets like China or other Asian markets?
It was always our intent early on to make it as approachable as possible. I think for the amount of technology that you're getting, I think we set a pretty high bar for ourselves in terms of pricing it as at a level that we think is approachable and accessible by as many people as possible. That was something we set from day one in 2018, what we wanted the price point to be, and we worked really hard at that. Of course, there will always be improvements over time in terms of driving down costs, and that will always be something that is important to us. How can we make this as accessible by as many people as possible?
Humane CEO Bethany Bongiorno, thank you so much for joining us here on Bloomberg Technology.
Absolutely.
Thank you for having me. Really appreciate it.
Well, that does it from this edition of Bloomberg Technology.
Such a massive show to recap. So many CEOs. We have the podcast wherever you get your podcasts. We're on the Bloomberg terminal and also on Apple, Spotify, and iHeart. 4 days into a big New York week. This is Bloomberg Technology.